Ừm, Okay, Assalamualaikum warahmatullahi wabarakatuh. We'll need you guys to respond through the chat once you feel that you can hear me and watch the video. Okay. So sorry for the delay. I will have to buy some time to give your friend maybe 1 or 2 minutes to join us. Basically, I was dealing with the issue with the WhatsApp actually. Okay, thank you for the response. All right. Again, I will have to apologize for the delays in our class. Right. So before we begin the class, and we are supposed to discuss on written errors today, so I will have to share with you this thing. But I also hope that this particular information will be among us only. Um, Especially this should be considered as confidential and perhaps private information. And also, once you heard of this news, I'm informed to you about it. I hope that you will not make any uh, harassment or disturbance to the particular person which I am about to share with you. Okay, so Dr. Fadilah, the academic advisor of in the Department of Finance, is having some difficulties. She is currently warded, and so maybe you are not supposed to disturb her, but maybe it will be good for you and also for her as well if we can pray for her safety and for her best of health. Okay, right. So that's the thing. Dr. Fadila is currently not in a very good condition. She is warded and waiting for more treatment. Right. So okay, I'm just buying some time, waiting for more to join us. Okay, before we get into the class. Well, I was thinking to finish the class earlier, but it's we started about 10 minutes late. Then I'm not so sure what to expect now. Okay, hold on. All right, so we will discuss on this chapter. First of all, we'll have to again apologize if I responded late to your questions in the WhatsApp. Okay, please keep on asking questions. I do appreciate all those questions. Some of you forget to mention your name, so please do so. Please mention your name first before you ask me question in the WhatsApp. I most likely will not save your phone number. There's too many names in my phone number, and I'm getting confused. So I somehow I forget to save your phone number, and then I will tend to miss up between you and perhaps some other students in the other classes, especially from my postgraduate classes as well. Okay, so let's not waste any more time. Our discussion today will center on the topics of return and risk. All right, so the discussion here is perhaps something that you have heard for so many years, but if someone asks you on how to define return and how to define risk, then well, that will be something different. Okay, and let me remind you, the discussion today is also centered on the return and risk with the calculation focusing on the single asset issue. What's the difference between single assets here? What's the importance of understanding the single assets here? Right. Uh, when we talk about single assets here, we are discussing basically the thing related to only one single investment. Because later we will be doing calculation on a portfolio. And remember, portfolio will be a combinations of investment in one particular fund. Okay, so that will be two different things. So you will have to focus and remember that what we are going to discuss here is basically things related to single investment. So we could be doing calculation for single investment A, single investment B, C, D, and E. But it can be done together, but it will basically be calculated based on their individual performances. None of these will be calculated as a pair or as a team or as a group. Okay, that will be the case here, the situation that we are going to embark on. Right? So stay focused. Right. Okay. Okay, now let's continue. We first discuss about return. Okay. So what is return here? Return, as I discussed in the our class, in our the slide, could be the income or in the sense of income or in the sense of capital appreciation. Can be both or can be either one. When we talk about income, it must be something that you will receive periodically. Okay, let me rephrase. It could be something that you receive periodically. Could be in the sense of annually, monthly, quarterly, whatsoever, or even daily. But remember that income also is not a must in the case of stock. For example, in the case of dividends, it is not a must. You could be getting the income, but it doesn't mean that the company will have to pay you the dividends. It is slightly different as compared to, for example, coupon or the interest that you receive from purchasing the bond. That will be different thing. And the rent, okay, the rent here in the case when you purchase a property and you lend it to the tenant, particular tenant, so the tenant are supposedly going to give you the particular rent every month. Okay, in that context as well, you can consider that income as your return. Okay, right. That will be the first part. But you must also notice that this income will normally not be considered as the most portions of the largest portion of return, because the largest portion of return normally will goes with the capital appreciation. Okay, a capital appreciation is basically when you the profit or the return that you get from the changes of the appreciations of the value in the particular asset. Ideally, you are going to buy something at the lower prices and then you sell it at higher prices, you get the profit. Right. So why I say it is the larger chunk of return will come from the capital appreciation. Now, it's not difficult to understand this. Let's go back to the example of property. If you are taking profit return from your income, meaning to say you are getting the rent every month from the tenant. So maybe for per month you will be able to get 1,000, for example. Okay, 1,000, and in a year you will be able to get 12,000. Okay, for how long? That will be another discussion. Okay, but from the short term horizon, just consider if you purchase a property and after several years you are able to sell it back. Let's just assume that you purchase it you acquire the property at the price of how much? Let's say 700,000. Okay, and after several years, you are going to sell it. You meet your particular clients, and then someone interested to buy your property. You sell it to the property to your clients, maybe at the price of from 700,000 now 1.5 million. So in a matter of time, perhaps in short term horizon, let's consider 5 years maybe, you manage to sell after 5 years, then your profit from the capital appreciation could be 1.5 minus 700,000 will be 800,000. Very high, very good as well, as compared to the income that you receive from the rent. Okay, so but you also need to consider several other things when we discuss about this, which we will get into it later. Okay, so just some simple discussion first on this particular income. Okay, hold on, I have to deal with this thing. Okay, I'm experiencing some echo actually in my phone here, causing me some problems here. Hold on. All right, I will try to continue. In the meantime, let me share with you some interesting fact and figures. Eh? Okay. Yes, for brother and sister, uh, Next, a bit troubled by some of my internet connection just now. So sorry for that. Times reading trivial facts that I'm showing to you. Mana dia ni? Okay. Have some on this several of things. Very interesting factor. Apa nak keluar? Penat prepare tak mau keluar pula kan? Right. Okay. The story back there. I know nowadays students prefer to look and perhaps to visualize things. So you prefer perhaps to read by yourself rather than listening to what I'm saying. So I'm prepared to use some trivial fun facts about investment as well. Have a read. I will share more to you later. In the meantime, also have this particular. We'll continue with the particular talks on return. Now, the next part will be discussions on how to measure return. Okay, so every time, in fact, not only about return, every time you want to measure something, you must be sure first of what kinds of tools that you want to measure and what you need to measure. That's why I give you this example. For example, when someone is going to measure the distance from Gombak to Ipoh, you could find that they could be using the different units of tools, units of measurement. For example, in the case of Ali, if he wants to know what will be the distance between Gombak to Ipoh in order to plan the time he should depart Gombak, for example. So what he might want to know would be the distance in the units of measurement, in the with the unit of measurement. In this case, will be time or hours or minutes, this kind of thing, right? So his unit of measurement in that context will be hours. But for Abu, someone who is actually going to rather interested to know about the distance because he is applying for the traveling claims, then he might want to measure it based on kilometers. You can see that, of course, there is a connection between time and the kilometers, but that will be for those who are doing the mathematics and also maybe the surveillance, not related to us. My point here is everybody will have a different kinds of units of measurement according to what they need. So similarly here, when we want to measure return for our investment, then you must first identify what do you want to calculate. Do you want to calculate the return based on your time horizon, or is it based on the appreciations of the stocks, or based on your portfolio, or some other things based on risk? These are the things that you must identify first. And which one is the most correct way to do it? No, we don't have that particular things. All are correct and all can be done. And again, it's up to you. The beauty of investments and finance is that you can give any kinds of answer as long as you can give the justification and provide the evidence. That will be the more challenging part. Okay, you can say whatever you want. Between two choices, which one is better? I'm choosing A. They will ask you, but why you choose A? You come up with your calculator, you come up with your justification. Fair enough. Okay, so that's the thing. All right, some of you are having some lagging problem. I hope it won't continue. Okay, sorry, I'm not so sure whether it is my internet or on your part. Maybe my own internet. So sorry for that. Okay, let me get back to the measurement of return. So now you won't find this in other types of textbook. This is from my own understanding, and this is how I'll clarify things. Okay, so I prefer to basically categorize things. So this is the way I categorize the return measurement. As you will see that some people will measure return over a period of time. So they want to measure their return. What will be their return if they hold it for 1 year? If they want to sell it in a year time, or in 2 years time, in 10 years time. This is what we call as the return measurement over the period of time. And under these kinds of categorization, we would be having the holding period return and also the internal rate of return. Okay, so HPR will be part of our syllabus this semester, whereas IRR I will not be touching on it. I believe you have been reading on or rather, you have learned this IRR during your FM or business finance when you were in the first year, I suppose. So I'm not going to repeat that. I suppose you have also study a little bit on HPR, historical and expected return. But I will need all this because we will later discuss more on the calculations of portfolio return, and this will serve as a basically the stepping stone to those details calculation later on. Right. Okay, so HPR, as I noted here, some limitation of HPR is perhaps it does not consider time value and risk. What does it mean it does not consider time value and risk? Time value in the sense that when you calculate the HPR, you will consider beginning value and ending value. But let's say your ending value is in 3 years' time. What happened here is you do not consider the effect of inflation in your calculation. So not to say that it is wrong, but depending on the nature of what you want to calculate, then you must be aware whether it is suitable or not. Okay, and also you will not be able to use HPR for prediction. Prediction here meaning to say that you want to know what will be the stock price in, let's say, 5 years time or 3 years time. You cannot use HPR for that, right? So and also some other issue with the income, which we will tackle later on. Some although HPR that you learned perhaps previously was a little bit maybe straightforward, it could get a little bit complicated when we deals with your portfolio for HBR for portfolio. In the case where let's say you have three stocks, you hold for 5 years and then you sell one particular stock out of three, and what will be the effect on your the whole of your portfolio HBR? It will not be that easy. So expect that to come in later chapters. Okay, for the time being, it's okay. We focus only on the return. Okay, IRR. As I said, I will skip that. So we move directly to the measurement over return and risk. So this kind of calculation will depends a lot on return and risk. So you want to know what will be the return given a certain particular risk. So it is also important because for some people who perhaps we say having a less risk tolerance or risk averse, afraid of risk, afraid of taking higher risk, then they will normally be looking into this kind of return measurement. So we can have two. First is historical, and you will see that most studies, most research analysts will still be using historical types of calculation, whereby we will be using past data and then use the sum of average in order to ease our calculation and also projection. Right. So we will later, I will assign you and embark you on the assignments related to this historical return. Okay, but don't worry, I will give you about details on that later on. Right. The other types of return and risk trade-off measurement will be the expected return. This one is more advanced in the sense that most of the people involved in this, or most of the um, um, in the analysis using these kinds of methods must have the very big info. I mean, big circles of information to ensure that they have all the information to come out with the prediction of scenario analysis and the probability. You might not be aware of that because normally for expected return, as I suppose if you have listened to the slide, then you will know for expected return, you need all the calculation, all the percentage, or the probability, rather probability, not percentage. So probability, what will happen in the case of good investment, good economic, moderate economic, worse economic. So they will attach together with some probability. It seems easy to calculate, but in reality, when you want to come up with those probability, then you will have to justify everything that you do, right? If you later continue with your postgrad master, you come and meet me again for the portfolio management class. Then I will be teaching you on some of the techniques in order to basically come up with the probability, right? So that will be another point. But perhaps not very suitable beyond it is beyond our class, at least for time being. Okay, now this is the formula for the calculations of holding period return. Uh, I am not going to touch on this much. It is in the slide. I already attached the audio together with it. Just pay more attention on how you can calculate the capital gain or capital losses. Later, you can try the exercises, and also uh, maybe you might want to retry the example that I attached here. Okay, so if you have any questions, then you can always ask me through the chat system. I will respond to the questions so far. Yalah, lupa tengok korang sini kan. Sorry ya. Ideally, I am supposed to have two laptop in order to deal with kind of StreamYard thing. Yeah? Okay, I'm still adjusting. So let me have a look into some of your comments here. Uh, Alamak. Maybe okay. So you are having some problem with the lagging issue, eh? But Ilham, I hope it is getting better now. Yeah, I suppose yes. There's a certain lag here. I'm so sorry about that. Okay, Aina Shafika also is having this kind of lag. Yeah, I do notice that. So sure what happened here. Okay, I will have to continue, however. Okay, so I attached to you together the chapters of written and risk. That in this particular week, our focus should be on the writtens. The discussions on the risk will be done, inshallah, next week. Okay, here, this one. Just now, I share you a tip on the Japanese trader who make a very costly mistakes when inserting his proposal or bidding, right? Okay, not bidding or asking. He was supposed or intended to sell one share of Jacob's stock for 640 yen, 640,000 yen, but instead he accidentally typed into the system as 640,000 share price of 1 yen. If you notice the Japanese currency, the yen play a vital part because 1 yen is very small in comparison. You cannot buy anything with those 1 yen. Okay, the second figure here to you will be on this the other co-founder of Apple, which is Ronald Wayne, and the situation when he unfortunately didn't basically calculate the value correctly for the Apple, and he missed out the chances of being another billionaire. Okay, as you can see that what happened here in the case of this particular the co-founder of Apple, perhaps we can see the misvaluation or being a human, you will not be able to predict what will happen in the future. So that was the case of Ronald Wayne. Unfortunately, he sold his 10% shares of the company, and he at that time only get 800,000, $800, but the value of that 10% would be today 35 billion. And yeah, that's the thing. Okay, and there's a lot of history about Apple and also Steve Jobs. Okay, if later throughout the semester we will share all these trivial facts and things, just to get you to be more interested in investments and also uh, the class. Okay, right? Yeah, I am also roughly okay. Connection. I will continue if you have anything in the chat system. Okay, not so sure as well what happened today. The weather is fine, but still, we would never be able to predict these kinds of uh, problem with the connection. Okay, right. So the next part, after we done with the exercise of audible return, we move into the calculations of historical return. So as for the historical return here, be careful that we have two different type of historical return: arithmetic average and also geometric average. Okay. So as for the arithmetic average or arithmetic mean, the formula is different and the geometric average formula is also different. A lot of times, student finds it easier to calculate the arithmetic mean or the arithmetic average. Okay. Except that I want to stress on the importance to understand all the symbols that we use here. So RI here, for example, will be the rates of return. Sometimes it is also called as the excess return. The excess return means the difference between two periods, whether the period is 1 day, or rather the difference in between the days or the weeks, the months, or sometimes even the year, we still can call it as excess return. And since that will be the sample, that will be our rates of return, right? So remember that in the calculation of historical return, you must be aware that it could sometimes be considered in the sense of days, sometimes months, sometimes weekly, sometimes quarterly, and sometimes year. It depends on the information and the data given. So it can change at any time. So be careful with that. The R bar, the big R with a certain line underline over above it, is considered or called as R bar. It is the arithmetic mean return or average return. Okay. For geometric mean, we will normally call it as GM, but under some situation, we will also use this GM as our R bar. Okay, but that will be under very extreme condition, because in most situation, okay, this is very important. In most situation, you will find that your arithmetic mean will be higher than your geometric mean. So given that it is almost like a rule of thumb, your arithmetic mean is higher than your geometric mean, then most of the time we will be using the arithmetic mean in the calculation of return, the calculation of risk later on. Why is that? Because you want to use a better return measurement. The higher the return is perhaps the better for you in order to calculate your risk. Okay, so remember, in between these two, once you work into the calculation later on, you must always find that arithmetic mean is higher than your geometric mean. If it is not so, then perhaps there is some problem with the calculation. Okay, and yeah, and another thing that every time will cause lots of controversy in the class, especially for those who are very particular with the mathematics and statistics. Now, the issue of n, especially later, we will look into the standard deviation, and under the standard deviation calculation, we would be having this n minus 1, the issue of n minus 1 here. Now, in statistic, we will be using anything divided by n minus 1 when we use the sample. And we will be using n or divided by n when you are using the population. Okay, but when we talk about our class here, it will be very subjective in order to define which one is sample and which one is population. So to ease our understanding, let's assume, okay, and in fact some textbooks do this as well. Let's assume that your n here is actually the number of the rates of return, the number of Ri. Okay, so whenever you want to calculate this, there is no more issue whether it should be n minus 1 or n, because normally you will take n based on the date or the period, but you don't have to focus on that. Just use n equals to the number of your rates of return. So we will be using this throughout the semester, so be careful. Do not mess up with things here. Lots of time you get a different answer, and of course normally Dr. Azmiza and I will still give you marks on that, but you are causing us some problems because uh, we will have to prepare a different set of answer when students will come up with these kinds of calculation. Okay, so yeah, bear in mind we do have two calculation techniques for historical return: arithmetic and geometric. Okay, and which at almost all the time arithmetic mean will be higher than geometric mean. But at the same time, if someone asks you which one of these two is more reliable, reliable in the sense of perhaps statistic, then the answer will be geometric mean. Okay, arithmetic mean is a normal average, the mean return. And these kinds of mean return are easily influenced by any outliers and bias. Just consider this situation. If we have 4 students in the class, okay, let's consider 4 students. Each of them wage, we want to know what is the average wage of this of the class. The class is only consists of 4 students. So the first student come out, the wage is 50. Second student 52. The third student 54. And suddenly the fourth student wage 90. Now that fourth student is considered as an outliers. The others are waging around 50 to 52. So the mean between the three of them is actually only 51. But when you have someone who suddenly come out with these kinds of outliers, 90, suddenly the calculations of the average will be somewhat biased. Okay, it doesn't really reflect the situation. That's why while doing research, some research normally, some academicians will take out all these outliers. So they will prepare two set of result. The first result with outliers, second result without outliers, to identify whether there is a significant difference between the two. Okay, so the issue of outliers here is perhaps why I would say arithmetic mean is less reliable as compared to geometric mean. But then again, when you want to do the calculation of risk, you will still use arithmetic mean. Why? Because it is better. It is always higher than geometric mean. Okay, so those things I did not include in the slides, right? So you will only understand that if you join the session here or you revisit and re-listen to the session here. Okay, so those are important things as well in the calculation. Next, here I gave you some exercise for you to try, and I also prepared you an answer for arithmetic mean for stock A, and also geometric mean also for stock A. So your task is basically to prepare the arithmetic mean and geometric mean for stock B, and I will later put the questions for you to answer in the Google Classroom later. Okay, need time to focus on all these kinds of things. When we start getting into chapters with calculation, then preparing the slide will be slightly more difficult because I will also have to try the questions before I give it to you. And if you find any miscalculation here, please let me know. We will have to correct those things. There is also chances that I made some silly mistakes here, especially because of the pressure of coming out on time with these kinds of things, lots of things to prepare. I'm not giving excuse. It's just some of my perhaps limitation and weaknesses. Okay, so this is considered exercise 1. And then we go to exercise 2. For this exercise 1, the notable differences between exercise 1 and exercise 2 is that in exercise 1, you are given the price. These are all in ringgit Malaysia or dollar. So I put in here, given price data. But when you are dealing with exercise 2, you are given the rates of return data. These are not prices anymore. These are the rates of return. This is already the RI. So there's a huge difference between the two in terms of the calculation. But then, given that we have agreed to use N as RI, so in this case of average return, I suppose no more problem. Okay, remember N will be based on your RI, and these are already your RI. So simply you can take the summations of all these 5, or the combination of all these 5 divided by 5. You will have the average return here. The thing will be slightly more challenging in the case of geometric return because you will have to do the adjustment. One of you already asked me whether in the case when the monthly average return is all positive, do you need to do an adjustment as well? I would suggest you to still works on the adjustment here, because the more important thing in order to do why we are doing this adjustment is to make sure that your figure lies beyond the percentage form. If you keep it as 20 times 15 times 9 times 22 times 17, then you could be basically found the figures too much to handle. Okay, just imagine 20 times 50, what will happen? And then times 9, the figure is getting bigger. Of course, you will later find find it. You will be able to calculate it to the power of 1 over n. Then the figure will get smaller. But yeah, to avoid any mathematics problems or technicalities issue, then perhaps I would still advise you to change and to adjust it into these kinds of calculation, and it will ease your understanding, I hope. Right, this is geometric mean. Remember, historically we have arithmetic mean and geometric mean. Okay, next we get into the expected return. All right, so what's the difference between historical return and the expected return? Historical return, just now you get the data from the past prices. These are data from the past, past performances. Okay, the data is available. You can easily download those data in the Yahoo Finance and some other website, or DataStream or Bloomberg. It is available, okay? Or in case you want precise data, precise price movement, you can also ask pay for the data, but to the Bursa Malaysia website. So they will basically, if you pay them, then they will release the more precise data with times and also with the proxy of the buyer, or maybe the platform of the buyer that the buyer use, or the dealer. Okay. Whereas for expected return, then the data is actually created based on the scenario analysis and probabilities. So expected return data is perhaps more relevant to the predictions of stock prices in the future. Okay, having said that, since you depends a lot on your own analysis and the scenario and probabilities, there is always chances that expected return calculation would be totally what should I say, will be having more risk or uncertainty as compared to the calculation of historical return, at least in the usage, because historical return will basically represent your past and what it brings you today, right? Expected return is basically ignoring your past but simply focusing on what you will become in the future. That will be the expected return. So we can say that what happened in the past, although it will remain in the past, but it somehow reflects who you are today. The stock today is the reflection on the journey it has been since the IPO, since the establishment up to this point. So whatever it is at the price today must surely incorporated all the past performances, past issue, past changes of CEO, the negative time period, the life cycle is all being basically incorporated into the current price, right? So it is almost perfectly telling you the story of what happened in the past. This is the this is me, and this is what I have happened to me from those experience that basically shape my price. Okay, that will be the stock price calculated using historical return. Why is it still important? Because from the past, you will be able to know what will be the average performances. From the last 10 years, what will be the average performances? If we want to summarize, how were you in the last 10 years? Then you will use the historical return. Uh, Expected return, more like you want to predict what will happen to you in the next 10 years. So, of course, the prediction for the next 10 years will be more, perhaps, uh, less precise as compared to the prediction for the last 10 years. Okay, so I hope you get that idea. And in reality, if we want to get these kinds of expected return probabilities, then you will have to perhaps pay for the data, get the data from multiple sources in order to come up with these kinds of projection. So it will not be very easy as well. Okay, unless you are working with research analyst firms or investment bank who would normally have their own way to calculate the projection of this expected return. Okay, this will be the calculation technique for expected return. Exercise 3, and I show you the calculation based on, or rather calculation for investment A, right? So you will then try for investment B. Okay, so risk, I will reserve this for next week. Let me get back to you now. First, let me stop sharing the screen. Let me get back to you and then stop anything. Okay, is there any questions or anything that you want to ask? Okay, you are much welcome in the chat system now. Okay, anything? Even from the maybe questions from last class that you feel important to discuss. Right. In the meantime, I'm sharing with you another trivial facts and interesting fact as well. The New York Stock Exchange, okay, is considered to be the most traditional as traders is investors. If you want to get into the office, you cannot enter the floor of the exchange if you are not wearing a suit and a tie. So it is a must for you to wear properly to get into the NYSE exchange. Okay, okay. So next question today is compared to last week, perhaps due to the buffering. Okay. Hey, tak ada soalan. Okay, yeah. I remember that I received two questions from your friends related to uh, the past chapter on the security transaction, especially on the issues of how to understand margin and also about short selling. Okay, so since we have perhaps another 5 minutes to go, let me try to perhaps make it clear when we talk about margin. Okay, quite confusing. Margin is actually referring to the equity. Okay, no margins mean. But by the way, the term margin itself refers to taking an advantage of something, right? You have the margin in the sense you have the edge over something, you have the advantage over something. So that's why they use the term margin trading, because they believe that if you use the borrowed fund, then you will have getting a profit or getting an edge over normal trading activity. So they kind of assume that if you use a margin, then you get the advantage. But what does it mean by margin? If it is a 30% margin, what does it mean? Now remember that you will first have to open a margin account. Okay, establish a margin account with the particular investment bank. Right. So this margin account here, once you open it, you will have to adhere to their maintenance margin requirement. So let's assume the company or the investment bank set up a 40% margin or 40% initial margin. Okay, what will it be? It would be that you will have to basically cash up or deposit 40% of the stock value or the value of the transaction that you involve in. It will be much easier when you have only one stock transaction. If you have more, then of course it will get to be more complicated. Okay, having said that, when they say 40% margin, it means that 40% of the thing will comes out from your own money. That will be the equity. Then so 40% from your own equity, meaning to say the other 60% will be the debit balance or the borrowed fund, right? So 60% margins will means that your equity is 60% of the total value of the total transaction. 40% will be the debit balance or the borrowed fund. That's how we must understand it. Okay, and what the other question asked to me throughout the weeks, I forget. Okay, hey guys, are you still with me? So quiet, so you get me worried. Okay, can someone respond to confirm that you are still with me through the WhatsApp or through the chat system here? Okay, okay, thank you. Right, right. I will make some of you famous here. Okay. Yeah, the selected person who will be placed this particular slide, brother, in this particular show. Yes, Nur Hanani. And you are okay, brother or sister from China here. I'm not so sure what's how to pronounce your name. You are using your Chinese name, perhaps. I can't read that. My mother-in-law is a Chinese actually, but she didn't practice her Chinese for more than 10 years. 10 years, for more than 30 years since she get married to my father-in-law. So unfortunately, I couldn't practice my Mandarin skill with her. I do take the Mandarin course during my time. So my wife is look almost like a Chinese. That's why all my kids looks like Chinese as well. So in the house, it's almost clearly that I have the largest and the biggest eyes. Kutuk anak sendiri tak apa, jangan kutuk orang lain. Okay, so ah, uh, thanks for joining us. Joining us. Thank you for joining me. Since there is no more questions, so we will perhaps continue in our next session, most likely next week. In the meantime, make sure you try all the exercises. The focus is for this week particularly is more on the calculations of return. Next week it will be more on the risk. So if you feel that, wow, sir, there is lots for me to calculate, lots of example to try, and also lots of exercises to do, don't worry, take your time, because this week is only on written. Next week we will do for risk. Right. So the discussion on risk will continue next week. So that's all for today. Thank you, those joining me on the session. I'm so sorry for the difficultiness, especially related to this lagging issue. Okay. So take care, everybody. Stay safe. Assalamualaikum warahmatullahi wabarakatuh.